Hello, everybody, and welcome back to Capital Ideas. I'm Nick Morgan, the co-founder of ICANN, Investor Choice Advocates Network, and one of the co-hosts of today's episode of Capital Ideas, where we explore the innovations that enrich our lives and the capital process that turns those ideas into reality.
I'm Mark Hiraiti. I'm co-host of Capital Ideas and Senior Legal Director and Policy Counsel at ICANN.
And I'm Darrell Albright, co-host of Capital Ideas and a very proud board member of ICANN. And today we are joined by Dave Hendricks, who's the CEO and founder of Vertala, which is one of the earliest players in the securities tokenization space. Welcome to the show, Dave. We're happy to have you on.
Great to be on. Great to see you all again. Thanks for having me.
Dave, it's really timely to have you. I don't know that we actually coordinated it, but as you know, there have been significant movements by the SEC just literally in the last few weeks. A couple of weeks ago, the SEC staff issued a statement on tokenization, and it wasn't just one division. They were all the divisions: CorpFin, investment management, trading and markets. And sometimes one will issue a statement and may not be all that well coordinated, but this time the statement is very well coordinated. It goes into a great deal depth on what the divisions envision for securities tokenization. And then just a couple days ago, Commissioner Mark Ueda, at a speech to the Asset Management Derivatives Group, I think, basically acknowledged that tokenization is in its startup phases. It's no longer a theory, and they're moving on it. And as you know, I think last month the staff issued a no action letter to DTC to institute a pilot program on tokenization. I think we're very fortunate to have you because you've been toiling at this for several years now, I believe. And I have to imagine you envision that we would be exactly where we are, because I believe you're a transfer agent. And my sense from reading the statement was that the SEC is basically saying securities are still securities. They're going to be regulated as such. And it's the transfer agents that are the ones who are going to, I think, kind of implement the transition to blockchain. So given all of that background, maybe you can address where you come from, where you are now, and where you think we will be in 3 to 5 years in terms of the market and how investors are going to benefit from that transition.
Yeah, we're at a enchanting but not magical time right now, as Commissioner Peirce said last summer. With the recent statements and the kind of it's an all institution effort over at the SEC. It's an exciting time for companies like mine, Vertala, and other people in the tokenization industry. A lot of people got here different ways. I started out my career at Arthur Andersen, implementing accounting systems. After I left Arthur Andersen, I worked on unwinding the S&L crisis in the middle of the 90s at the Resolution Trust Corporation, securitizing real estate assets. And I then I ran the worldwide relationship between Oracle Corporation and Arthur Andersen. After I got out of that, I went and built CRM systems in email and first-party data. In 2016, after watching Ethereum and listening to Vitalik and thinking about smart contracts, and with a background as a CFO and a corporate secretary and entrepreneur and across the accounting database and CRM, I came to the realization that distributed ledger technology was a step function improvement in shareholder rights and data management. And it was kind of like, it kind of just came to me that this is actually going to be a really, really important change. Because if you've run cap tables, you run securities offers, you run all this stuff, there's a lot of spreadsheets and things floating around, and there's a lot of lack of precision. And when you have questions, there's lack of trust. But it's not exactly where I started, because I couldn't really start there. So the first thing I did was I went back to another idea. And initially, the way the company Vertala got started was I built an Ethereum-based human capital due diligence system using smart contracts to connect people with organizations to validate them. And in September 2017, I wrote a yellow paper and a white paper thinking I was going to do an ICF for the first version of Vertalo. Well, I took that to Gautam Gujral, my general counsel co-founder, ex-SEC, Division of Markets. He wrote Regulation ATS when he was there as the lead author of their white paper. And he took it to our lawyers at Lowenstein Sandler, and they both came back and they said, no ICO for you, Dave. That's it. That's an unregistered securities offering. And I'm like, rat. But then I said, well, what if we did a tokenized securities offering? So in October of 2017, Lowenstein Sandler and Deloitte and my holding company that I run decided to spin up something called Vertalo in the Cayman Islands. See the beach behind me. Our colors are based on the water Cayman. And so what we did was we went through the whole tooth to tail process of creating what was then known as an STO. And this started like in November, December 2017, set up in Cayman. And then on March 8th of 2018, we launched the first, I believe it's the first Reg D, Reg S, private placement digital securities tokenization. We wrote all the smart contracts. We did all the distribution, 108-page PPM, legally and from a tax perspective, like just lines like T's crossed, I's dotted.
Dave, is it fair to say that, well, everybody else seemed to be jumping on the crypto bandwagon in 2017 on the front end? You were basically building the plumbing.
Well,
infrastructure.
we'll get to that. That's the whole thing, Mark. You're reading ahead. It was not a success from a fundraising perspective, Mark, in March of 2018 to issue a tokenized equity, a completely non-marketable, illiquid tokenized, equity when everyone else's ICOs and exit in and out, and they wanted to be traded. It was a potential fool's errand, but I really thought that this was like something useful and cool, and it was the offering, not what I was raising for, but the process of doing the offering. So 2 months later, I saw another big name in the space, I'm not going to say who it is, at a conference talk about issuing tokens. If you're an issuer, issue tokens to a self-sovereign wallet and they'll make their own marketplace and all that. And I was like, wow, that sounds a little chaotic to me. And I went to my hotel and I had a dream, and I woke up the next day. This is May 1st, 2018. And I called the company. I said, we're pivoting to become a digital asset data management platform. And the whole thing was, I thought that everyone would want to tokenize their equity because it's a better way to record it. I thought that it was great for investors. I thought it was great for issuers. I thought it would be easy to regulate. And having gone through it as an issuer and having to write all this and build the tech, I'm like, issuers should not be doing this. Okay. They should be able to go and do this and focus on their offering or their shares, but not focus on building technology. I believe that to this day. I still believe that you either issue instruments or you build technology. And the companies that are doing both, I think they'll do neither expertly. So we started building a platform that would connect and enable the digital asset ecosystem. My mission was never to tokenize the world. It was always to create a digital asset management system that would facilitate primary and secondary, broker dealers to onboard capital and to get liquidity. And we started commercializing it in Q3 of 2019. And then people started calling us. And we've never made an outbound sales call here at the company. And we've worked with over 100 issuers, all kinds of different things. And so that's how I got into this. Okay. And even through the successive winters, 2018 winter, 2022 cold summer. Okay. And now we're in the latest kind of early 25, 10-10, 5-5 winter. Okay. I've stayed really true that I believe distributed ledger technology is a step function improvement on share ledgering in spreadsheets or central databases, and that it is as profound as the invention of double entry bookkeeping by Luca Pacioli or the Medici's creation of letters of credit. Okay. It's a once in a century systemic upgrade for the financial system. So, and so that's how I did this. And, and I stuck to this knitting, building a platform that would simplify this and enable it to snap into and be used by both private, ultimately public, but private companies primarily, because that's where the liquidity issues are. But ultimately, it could be used in just a plain asset management context. So it's an exciting time. And tokenization is a key part of that. But there's much more to tokenizing the world than issuing the token. And I focus on the hard part, which is the transfer agent side.
So it was interesting because you said, I guess it's towards the end of last year, that tokenizing private equity is going to be the most interesting trend as we head into 2026. And you're providing the system that enables that, but we're also seeing the regulatory landscape sort of shift a bit as well. And you had mentioned doing Reg D and doing this under various compliantly based on the SEC existing regulatory infrastructure. Do you see like a new regulatory system emerging that is outside of Reg D, Reg A plus, crowdfunding for this space? Like how do you see that sort of evolving?
I don't see that one's necessary. So let's go back to what you quoted something I said. Starting in mid 22. I mean, first of all, my thesis always was that this technology doesn't make it easier to raise money, and it doesn't make things liquid, but it facilitates both of those things. Okay. And once mid 22 started, okay, the cold summer where all the markets crashed, the IPO activity just dropped off a cliff. Fundraising also dropped off a cliff. And that hasn't changed. The IPO doors barely open. And a lot of GPs and LPs are having a lot of hard conversations. I mean, the same thing goes for private credit. Same thing goes for any assets. PE is not going to save everybody and buy and do M&A. So how do GPs and LPs, or how do companies, go to the next level if they want their shareholders to have liquidity? Well, this technology, offers you can produce novel instruments, okay, in private equity and private credit through tokenization. You can create hybrid instruments, and the reason why they're so interesting versus just like a legal structure is that you can imbue the instruments themselves, the tokens, with certain restrictions. Okay, you can create baskets of assets, much more easily. And then you can create derivatives off of the primitives themselves that offer exposure. And you see some of that in the swaps, things that Robinhood and Ondo and some of these other folks are doing. The technology enables different forms of liquidity other than just buy and sell. Okay. You can create exposure to assets that you wouldn't be able to get otherwise by using wrappers or by, creating baskets. So, private equity is either previous public companies that were bought out, or they're private companies that don't IPO and they get M&A'd, right? There's another way too, where the GPs who are running funds could allow LPs, long-suffering LPs in many cases who haven't had IPOs or had a refresh, to be able to exit positions, but with restrictions similar to programmatic ROFRs. Okay, all of these things can be done with the combination of ledgers, distributed ledgers, and tokens, and it's really up to. And there's no laws that are going to prohibit this. Okay, they're just packaging up equities or debt, but the technology enables a smoother packaging, and then and then they can be bought and sold in various different ways. There's just right now, if all of your shareholder interest is on a spreadsheet and you're sitting around paper or documents, it's not really as transportable and transferable. And so the token itself is a very, very interesting vehicle where you can apply both ownership and also trade and transfer rules. That's why it's amazing. You can't do that in a spreadsheet. You can't do that in a regular database. So I think that as there's still no liquidity out for, exits or for, technology and et cetera companies are few and far between. You see more SPACs and you see, native companies going public. You do see that this technology can perhaps solve some of those problems through packaging and through through distribution methods, which now, thanks to the statement, large financial institutions, RIAs, wealth managers, asset managers, they don't have to worry about getting sanctioned by the Fed or OCC or anybody else for using blockchain technology. And so that's why the statements are so valuable, because I've been doing this exact stuff legally for years. It was never illegal. I was just using it as a database. I never got a no action letter. Okay. But I had to always kind of straddle TradFi and DeFi. What the statements have done, they will unleash creativity more than they're going to unleash technology. Because all these plans of people, these ideas that people have had, and they've been scared to pursue them because they're like, is it legal to create an equity token? Okay. And there were, even in the National Venture Capital Association default fundraising documents for Reg D, Dara, there's a whole segment in there which is like bracketed. It's like default language, but it's in brackets. It says that the company will not issue a token. There are bylaws in funds that prohibit the purchase of tokens. Okay. So essentially what the SEC, that committee document, UATA statement, Sharon Atkins statements this week, the DTC, no action letter, they're giving cover for people to use this relatively innocent technology. Okay. It's an anodyne database technology, but to create new pathways for investors to come on and for liquidity to come out. And that's what's exciting about it.
It is exciting. I think you're sort of touching on this, what I want to ask about, and that is we're getting to the point where we might have regulatory clarity. But I think that's different. And I think you would agree that's different. Regulatory clarity is different than market validation.
I think we have 100% regulatory clarity now. Okay. I have zero quibbles with the SEC statement. Well, Vertalo can accommodate all 5 or 6, depending on how you count them, models that were laid out in the SEC statement. Some of them we think are more practicable and make more sense than others. But we were overjoyed by it because it represented reality. Okay. And so I don't see any issue with that. There's one issue which may come up, Nick, which has to do with swaps. Okay. So maybe, the Clarity Act, everyone's focused on the Clarity Act and like bank issued stablecoin interest, right? That's kind of been the thing that everyone's got hung up on. And I don't need the Clarity Act really for anything that I do, but it will help me in some of the things that I'm doing. The real issue it will come out relates to how do you allow or restrict, say, retail investors to purchase certain forms of financial instruments. And one of those things are swaps. Okay. So, the issue that Commissioner Peirce had in the summer that she didn't call them out by name, but she was calling out Robinhood for making tokenized swaps of private shares available. That's not something you can sell to retail. That's ultimately going to end up being an enforcement thing, and the attorneys at these financial firms, at least the ones that are big and exposed, they'll deal with that. And there are going to be people that are going to go out and they're going to wait for, regulation by enforcement. They'll just go at it because they'll figure that no one's going to pay attention. But nothing in the traditional securities world is hampered or really overregulated by the statements. In fact, I think it says, hey, you can do it this way or you can do it that way, etc. You still have to sell things to the appropriate audiences, okay? And it said, I mean, it says it like as many times as it can say it without being, repetitive, that the way that you store or record an asset, and that's all, or represent it, does not make it more or less of a security. Okay. And nothing, just because you tokenize something doesn't make it like a security of bearer instrument.
Right.
Yeah.
So with clarity, does it follow that we get sort of market validation and trust now that the regulators have made things clear? Does that mean more people will be willing to adopt the technology and sort of trust it? That's a separate question.
I think the Clarity Act, frankly, it's a little bit adjacent to me because it really has a lot more to do with exchanges and banks. Okay. That it does the SEC and the statements that we've been talking about are really, really straight on for transfer agents. And as a pure play digital and tokenized transfer agent, built all of our transfer agent stuff from scratch. We didn't buy it, and I'm a co-chair of the Securities Transfer Association's tokenization committee. I work with transfer agents. They're my partners. Transfer agents have now understand where they can play. Okay. Our association was even meeting with the SEC this week, and I wasn't there. I'm here. I have to do work, but those guys get to go have the fun stuff and meet with the commission. But transfer agents have been given a very strong lane. The problem for transfer agents is that transfer agents haven't really understood where this is going. And so no one was going to invest. And so it's going to be a little catch up. Almost everybody else is ahead of transfer agents for the most part, because this is not a small lift, okay, to redo the systems. But, people have been working on trading tokenized assets and moving those around in other ways for years. And so I think Clarity is going to touch on that. But I do want to say one thing about markets. The biggest impediment to tokenized equities is the complexity of the smart contracts versus like crypto. Okay. A well-written tokenized equity or debt instrument is imbued with restrictions and other rules that need to be parsed, okay, by any place that trades it. That's completely different than when you go buy some Ethereum or Bitcoin or Aptos or Solana or Dogecoin or any of those meme coins. They don't have any restrictions built into them. They're bearer assets. But the special thing about tokenized equities and tokenized instruments in the regulated space is that the tokens themselves, which are real ownership now it says that, like, you can issue them and they're not a proxy. Okay. They're more than a securities entitlement. Okay. They're actually the share.
Yeah.
There is a technical complexity at the trading platform which needs to be addressed. And that's the next like big area. You saw the NYSE talking about what they're doing. You see DTC, you hear about NASDAQ and these things. This is more complicated than trading digital dematerialized.
So Dave, does that require new and better L1s, blockchains, do you think,
No.
than what we have now?
No.
No.
We have enough blockchains. We have too many blockchains. Blockchains do not solve this. We need something that's going to be able to translate the tokens, the securities, tokenized securities, so that these trading platforms can handle them. Okay. Like our Vertala securities protocol, which we started working on in 2019, is a very sophisticated tokenized instrument. and it delegates control to custodians and to broker dealers and to investors and issuers. It has imbued restrictions. It's got all kinds of things in it. We built it as lightweight as possible, and there's other variations like you've heard of ERC 3643. These things are not easily tradable, and they can't trade them on Binance or Coinbase because they can't read the smart contracts and figure out whether this could be sold to a person or whether it is actually even eligible to be traded at that point. Let's say, for example, if you're under Rule 144, right? I mean, like if someone has the token, and it hasn't gone through its Rule 144 seasoning period, well, it can't be traded outside this pool, right? Well, then what's the pool? Tokenizing securities doesn't mean that now suddenly we have just ERC20s on steroids. They're like an army of ERC20s working together, okay, and in concert to protect the issuer and the investor and to delegate and adjudicate.
And what needs to happen in order for those kinds of tokens to be developed, do you think? Is it just the market?
Yeah, so market, and here's the good news. The market now understands the taxonomy of the different kinds of tokens. So the market can if you are developing a trading platform, an exchange, because these are exchanges, they're not order books, they're exchanges largely, but you can do it in order books too, like alternative trading systems. They now, I think, can more safely invest in technology that can trade these instruments. And the issue is how many varieties of these instruments can the market and the trading platforms really handle, right? Because it's not like, okay, an option is an option. A call is a kind of option, right? But an equity is not an option, right? And a derivative is definitely not more complicated than either a primitive or an option. If you look at tokenized securities, the closest thing you'll find in finance is a derivative, and complex derivative, like you'd say, that has inputs coming from various areas. So in order for this market to be successful to trade like public equities trade now on exchanges, that is the next area of investment that needs to be made. We don't need to, at Vertala, we don't need to do anything different for this to be the most amazing asset management technology, the safest and the most precise ledger, okay? The best way to steward data. We don't need to make any changes to do that. We'll just keep on improving what we do. It's the liquidity side, which now should look to these statements, look to the regs, and figure out how they can then let 1,000 flowers bloom, but not let 1,000 blockchains in, because it's, you don't need that many. There's some which are really great, and the rest of them are just, they're unnecessary, extraneous.
The innovation actually facilitates the liquidity for private equity, private credit that we've never seen before, and in a new way. But I also wonder, and I'd love to get your thoughts on even just how the blockchain technology itself, as I mean, I kind of see other even traditional equities, publicly traded equities, moving to the blockchain too. And maybe you could talk a little bit about some of the benefits of having putting this on a blockchain. Like, for example, can something like this curb short selling abuses that we see in traditional markets?
The number one reason why Patrick Byrne started a company called T0 was to deal with naked short selling. Okay. Distributed ledger technology, and specifically creating tokenized equities or whatever debt, whatever. When you issue tokenized securities, you're issuing them from a master smart contract, which is authorized to issue X number of shares. this is why it's both investor and issuer friendly, because the governing rules for how many shares are authorized, and whoever's on this call who's a securities lawyer, or anyone who's listening who's a securities lawyer, you always know that, like, oh, okay, we're doing another round. Okay, we have to authorize more shares. Okay. And you're going out to raise a round, you have amount that you can raise. I'm selling this many shares at this price. Today, markets there are creation of phantom shares. There's all kinds of shenanigans in there. Distributed ledger technology, specifically transfer agents, can make that go away pretty easily. Okay. But I would say that is at a foundational level below the market. Okay. To go to your first thing, so it's amazing for making sure that the float is not 10x the actual float. Okay. And today you don't know. And there's a lot of issues with that. And then that's another topic entirely. But the biggest problem with trying to replace, for example, NYSE or NASDAQ with, and have everything be on blockchain, has a lot to do with a concept called finality. Okay. And another thing called TPS. Okay. People get all excited by this thing called RWA, real world assets. What they don't understand is something called TPS, which is transactions per second. Okay. If you read Flash Boys, like, go read it again. If you haven't read Flash Boys, go read it. Because the issue with Flash Boys was that large, like firms, market makers, all these firms, they would literally lay their own fiber optic cable in the straightest way possible in order to shave off 10 milliseconds or 100 milliseconds to get trade data ahead of others. And that's that they would trade in those margins. The tokenized securities, like, operate in finalities of seconds at best, not microseconds, certainly not not milliseconds. Okay. And so the current markets are high frequency traded. There's all kinds of things going on in the background. There's no chain right now that even remotely gets there. Now you hear about layer 0, and these are all slide decks as far as I'm concerned right now, until they're practicable. DTC is trying to do some things in there with Canton. With some of these closed networks where the token and parsing the token and finality is not so much of an issue like it is in public chain architecture, you can get to some pretty high speeds. But as a believer in public chain architecture, for reasons of resilience and censorship resistance, and because of the innovation that goes into open things rather than the closed things, public chain architecture just can't keep up. Now, how do we address that? Well, in our system for Talo, we're managing the master security ledger on chain. We mirror it off chain to a very fast database, and we can send trades to the markets at the speed of light, but not using a token. Okay, that's the custodial model. If you look at the number 2 example in the statement, or the number 3 example in the statement, those are like kind of in that area. So Dara, you're going to be able to get to blockchain or tokens being traded, but the question is, are the tokens ever going to move? Do the tokens exist as an immutable instrument that you can see, okay, and is provable, that can't be, manipulated, but in fact, the trade will happen like digital dematerialized happens now? I think that's what's going to happen for a while, because otherwise it's not fast enough.
And let's assume that Congress enacts finally the Clarity Act, and there's some clarity around the jurisdiction of the SEC and CFTC over crypto and digital assets. And let's assume that things are moving with the regulators as quickly as they have been in the last month and a half. How long before you think there will be a wholesale transition to digital ledger technology being used in executing and settling trades on a wide scale basis?
It depends on what you mean by executing and settling. Okay. Whether blockchain is used as a record keeping system or whether it's used as the instrument, I can't give you an answer to that, but I can tell you some more what I think is going to happen in the next 3 to 5 years.
Please.
What you're seeing here, I think, with the SEC is two things, and FINRA and CFTCs are. You're seeing deregulation. You're seeing up regulation. You're not seeing dysregulation. Okay. And they're simultaneously with the statement deregulating and regulating. Okay. They're saying we're not going to do in regulation by enforcement. Okay. And you don't have to guess. But if you're going to do tokenized securities, these are the models that work. Okay. So simultaneously regulating and deregulating. I think where though you're going to see further regulation is really interesting. It depends on, and this could happen in a future administration, maybe not in this one. And this is why I really think should happen. I think that all assets should be recorded. These should all be recorded on chain. I think that, so I'm a ledger maximalist. I'm not a token maximalist. The tokens are the output of what happens on the ledger. Okay. They're the representation and the output. For private companies, I think it's not expensive. And I think that instead of using a spreadsheet or database, being able to show your investors their holdings and knowing exactly how much you hold and being able to see that, I think that's going to be a thing. I think I think that transfer agents and their clients will increasingly see a demand to, and this is also for the CEOs of companies. They don't want their companies manipulated in the market, so they're gonna demand that they get the protections of distributed ledger technology. Okay, this is different than tokens. This is distributed ledger technology. Okay, because it's immutable and auditable. I think you're going to see that, okay, as re-regulation, okay, in certain ways, okay, because it has both issuer and investor protections. If the SEC, who's acting right now on behalf of industry, thankfully, to give industry a way to bring these tools in, but also to put guardrails around them, if the commission wants to make this really investor friendly, then they say, then we start looking at books and records being on chain as the default, because it's just simply a better way to ledger, to record shares.
Yeah.
I think we'll see this in asset management too, because lessor relationships in asset management, where reconciliation times are days, and that could means millions or more dollars of interest, because when something was recorded, I mean, I think it's going to get distributed ledger technology is an asset management technology, full stop. It's not a capital formation or a liquidity technology. It's an asset management technology, full stop.
Right. But I think the next thing we'll see is from the commission is some relief to assist companies to raise capital to address these issues and innovate. So hopefully in the next month or so, we'll see some exemptions that are workable.
Yeah, I think so. I mean, you should be able to sell tokens to investors, and you should be able to maybe they'll change CF. I don't think that investors are as dumb as the regulators think they are. Okay. And as long as you can buy an iron condor when you're 18 years old on Robinhood, okay, like why? How are you stopping people from buying a token in this company? Why can't a 16-year-old buy a token? Okay. But they could drive a car,
You're singing our tune, Dave. Let me, I don't want to cut off Dara and Mark if they have further questions, but I did want to kind of close, if we can, with a question about policy. We've talked about policy in different ways. And it sounds like you think we have regulatory clarity on some things now. If there were specific policy reforms that the SEC could implement, or I guess Congress, where should they be looking?
First thing is, since we're talking crowdfund insider here, Reg CF is an absolute disaster. Okay. I don't spend a lot of time on Reg CF because no one spends a lot of time on Reg CF. I think working in Jobs Act is like to refine Reg CF to make it more useful. The number of hoops and the kookiness with Reg CF, like that needs to be fixed. It's just, it's unworkable. Okay. It requires, it's kind of like, it was practically written before cloud computing. I mean, it's so, it doesn't, and they moved it up to 5 million, I think it should be easier to facilitate crowdfunding using various methods. I think that's vitally important. Okay. But you can't, if you're doing a crowdfunding campaign, like spending all this money to hire a portal and all this sort of thing, I think that it's a lot of hoops. And it's a lot of hoops to set one up. Okay. So no one wants to set one up because then no one uses it. That's an area where I think we could spend a lot more time. Okay. That's an area of interest to me. I mean, I don't have a lot of quibbles right now that there's some guidelines out here. And I'm not really, all for people, business being forced to adopt technology. But, I expect there to be some of that, because I think that if you can use this technology, you can actually reduce the number of enforcement efforts that you need to put in place, because you can oracle the company and you're like, yeah, we're good. It can cut down your auditing costs. There's a lot of benefits.
Well, thanks so much for coming on, Dave. This has been very enlightening, and we're going to check back in a few months or, a year and see what developments have arisen in this space. So thank you very much for coming on. Dara and Mark, thank you as always for co-hosting. And for everyone else, if you want more information about ICANN, go to icanlaw.org. Thanks very much.